$600 billion. That is not OpenAI's annual revenue. It is not NVIDIA's annual profit, and before anyone starts designing a thumbnail with flames, it is not a signed $600 billion deal. It is the combined headline ceiling of two extraordinary financial arrangements reportedly being discussed between the company selling the world's most important AI chips and one of the customers that desperately needs to buy them. According to a Wall Street Journal report carried by Reuters, NVIDIA is in talks to provide roughly $250 billion in financial backing connected to an OpenAI data center project in southern Ohio. Separately, NVIDIA is reportedly discussing financing for up to $350 billion of OpenAI's purchases of NVIDIA chips. Neither proposal has been finalized, and the detailed terms remain unknown. Still, the structure is remarkable. NVIDIA could help OpenAI obtain financing. OpenAI could use that financing to acquire computing capacity built largely with NVIDIA hardware, and the money could eventually return to NVIDIA as revenue. In technical language, this has features that resemble vendor financing. In less technical language, it is a $600 billion boomerang. Imagine a property developer that builds an apartment, guarantees the buyer's mortgage, helps finance the purchase, and then announces that demand is booming. The apartment exists, the buyer gets the keys, and the sale can be legitimate. But the source of demand is no longer simple. Now replace the apartment with an AI data center, the buyer with OpenAI, and the developer with NVIDIA. Vendor financing is common in capital-intensive industries. But at this scale, it raises an awkward question: are NVIDIA's sales being driven by customers' cash or by NVIDIA's ability to help customers find cash? Today, we will follow the money from NVIDIA to lenders through data centers and OpenAI, and potentially back to NVIDIA is the demand organic. Who owns the risk, and what happens if the AI works, but the revenue arrives years later than the bills? Before we continue, one correction is essential. NVIDIA has not lent OpenAI $600 billion. The two reported figures are not one contract or a giant check arriving at Sam Altman's office tomorrow morning. One proposal involves a potential backstop of roughly $250 billion for a data center project. The other involves possible financing for as much as $350 billion of NVIDIA chip purchases. A guarantee is not an immediate payment. It is closer to telling lenders that a much stronger company stands behind part of the risk. The obligations, triggers, collateral, fees, and division of losses are not public. A headline ceiling is therefore not money already spent, or money already lost. The reported Ohio project shows why the numbers have become so large. Its ultimate planned scale is 10 gigawatts, while the first phase reportedly targets roughly 800 megawatts in 2028. 10 gigawatts is not a server room with improved air conditioning. It is grid-scale infrastructure requiring land, generation, transmission, cooling, networking, memory, and an ocean of specialized chips. The backstop would reportedly support financing connected to the project and OpenAI's access to capacity, not all the chips inside. If both arrangements proceed, the company selling the project's most valuable hardware could also help make the project financeable. Strategically elegant, yes. Financially intimate, also yes. So how could the loop work? NVIDIA begins with an extraordinary advantage, cash generation, and a powerful balance sheet. In its latest reported quarter, NVIDIA generated approximately $81.6 billion in revenue, including roughly $75.2 billion from data center. In other words, more than $9 out of every 10 came from the part of the business most directly connected to the AI infrastructure boom. Its GAAP gross margin was about 74.9%. That is gross margin, not net profit margin. But it is still the kind of number that makes ordinary industrial companies stare quietly out of the window. NVIDIA can use that financial strength to invest in customers, support financing vehicles, guarantee certain obligations, and encourage lenders to fund new infrastructure. OpenAI and a developer then obtain capital or better financing terms. The project buys equipment and creates computing capacity. OpenAI leases or uses that capacity. NVIDIA hardware fills a large portion of the facility. When systems are delivered under valid contracts, NVIDIA may recognize revenue. Stronger revenue supports NVIDIA's valuation and financing power, which can then help enable the next project. This loop is not automatically suspicious. Manufacturers often understand their customers better than banks do. Aircraft and equipment companies help buyers finance expensive products, and governments guarantee strategic projects. Supplier support can solve a genuine chicken and egg problem. Lenders avoid an immature market, but the market cannot mature without financing. NVIDIA may be breaking that deadlock. The danger appears only if customers increasingly depend on the supplier's support. A sale can be valid while its economic source becomes less independent. The question is not whether GPUs changed hands. It is whether final users generate enough cash to pay for the chips, buildings, electricity, and interest without the seller repeatedly helping to keep the system funded. To find organic demand, follow the money one step beyond OpenAI. OpenAI is a customer of computing capacity, but it must ultimately earn money from consumers, developers, enterprises, governments, and other customers that are not being financed by NVIDIA. Those outside payments are the economic oxygen of the system. If companies pay for AI because it saves labor, increases sales, or creates valuable products, the loop opens into the real economy and can support itself. If most cash continues to circulate among chipmakers, cloud providers, developers, and AI laboratories, then reported demand may grow faster than independent revenue. This is why user growth alone is not enough. A billion people can enjoy a service that still fails to cover the cost of serving them. Popularity proves usefulness. It does not automatically prove unit economics. The final payer, not the loudest user, is what turns technological adoption into durable cash flow. This matters because AI is changing from software into heavy industry. The popular image is a chatbot floating in a cloud. The physical reality is less magical and much louder. Accelerators, memory, optical networking, cooling towers, generators, transmission lines, water, concrete, and enough electricity to make utility executives reconsider retirement. Training requires huge bursts of computing. Serving hundreds of millions of users requires continuous inference. Greater efficiency may reduce the cost of each task while increasing the total number of tasks that is excellent for chip suppliers and more complicated for whoever finances the electricity bill. The fundamental mismatch is time. Data centers last for decades, but their most valuable chips may lose an edge within a few product cycles. A frontier model can lose its lead even faster. The project combines long-lived financing with short-lived technological leadership. Imagine a long mortgage on a house whose kitchen becomes obsolete every 18 months, and whose tenants leave when the house next door answers questions faster. Older chips remain useful, and demand may absorb multiple generations, but utilization, pricing, and upgrades become critical. Debt does not disappear because a new chip is more efficient. Concrete is patient. Bondholders are patient only when paid. Now we reach the most uncomfortable part of the AI boom. Revenue is growing, but infrastructure spending may be growing faster. Alphabet recently gave us a striking example. In the second quarter, it generated approximately $39.1 billion in operating cash flow. That is a very healthy number. It then spent roughly $44.9 billion on capital expenditure. The result was approximately negative $5.9 billion in free cash flow. This was not an operating loss, and it was not a failure of Google Cloud. Cloud revenue grew roughly 82% from the previous year. The problem was simply that Alphabet's investment appetite became even larger than its prodigious cash generation. When one of the most profitable corporations on Earth temporarily consumes more cash than it produces, the correct response is not panic. But a raised eyebrow is financially permitted. Alphabet is not alone. Microsoft, Amazon, Meta, Oracle, and a growing population of data center developers are competing for the same scarce ingredients: advanced chips, memory, transformers, turbines, grid connections, construction workers, and capital. In the first phase of the AI boom, the largest technology companies could fund most investment using cash generated by advertising, cloud services, e-commerce, and enterprise software. The old businesses financed the new one. In the second phase, capital expenditure expanded, debt issuance grew, and companies began relying more heavily on external partners. The reported NVIDIA arrangements point toward a possible third phase. The infrastructure supplier itself helps finance the customer and the projects that purchase its products. The AI story then stops being only a competition between models. It becomes a credit cycle, and credit cycles follow a less exciting but extremely stubborn law. Eventually, somebody outside the circle must generate enough cash to service the claims inside it. That outside cash can arrive in several ways. Enterprises can pay subscription fees, developers can purchase tokens through application interfaces, governments can buy secure computing capacity, advertisers can pay for better targeting, and consumers can pay for premium assistance. AI may also reduce costs inside existing businesses, indirectly justifying infrastructure even when the AI product has no separate price tag. But each path must eventually appear somewhere measurable: higher revenue, stronger margins, lower labor expense, or greater customer retention. Strategic importance is not a line on the cash flow statement. If companies cannot identify where the return appears, capital markets must keep funding the gap that can continue for years when investors are enthusiastic. It becomes much harder when interest rates rise, bond spreads widen, or shareholders ask the deeply unfashionable question: when do we get our money back? The telecom comparison is useful if we resist declaring that history repeats word for word. In the late 1990s, the internet was transformative, data traffic was growing, and fiber networks were necessary. Investors were not hallucinating the internet. They were often hallucinating how many competing networks could earn adequate returns simultaneously. Lucent, Nortel, Cisco, and others helped customers finance equipment. Lucent's customer credit and guarantee commitments were approximately $8.1 billion in its annual filing, while contemporary reports cited a peak near $8.4 billion. That was not an $8 billion loss. Actual outstanding exposure was far smaller. But when fragile customers failed, orders vanished, and portions of the financing book produced serious losses. The mechanism was simple. A risky startup wanted a network. The supplier wanted a sale. The supplier extended credit, arranged financing, or guaranteed obligation. The customer bought equipment, the supplier reported revenue, and investors rewarded the growth. While capital remained available, each participant pointed to another as proof. Suppliers cited orders, customers cited funding, investors cited traffic, and banks cited contracts. Then financing closed, customers with business plans, but insufficient cash failed. Orders were canceled, receivables deteriorated, and used equipment flooded the market. The internet kept growing. Many balance sheets built around its first infrastructure wave did not. The differences are obvious. NVIDIA is vastly more profitable, and major customers include the world's strongest companies, rather than only startups with optimistic slides and suspiciously enthusiastic neckties. AI already has broad consumer and enterprise use. NVIDIA also sees utilization, order pipelines, model roadmaps, and customer needs. Guarantees, equity, leases, and loans carry different risks, so calling every partnership vendor financing can substitute a scary label for analysis. OpenAI is not a random telecom reseller founded 3 weeks before the meeting. It has meaningful revenue, powerful investors, and a globally recognized product. But the central lesson survives. Revolutionary technology can attract poor financing. A bubble does not make technology useless, and useful technology does not make every investment sound. The internet changed the world after the telecom crash, which did not help investors who owned the wrong claims on the right future. The AI question is not whether the technology matters. It is which companies, projects, and debts can survive until revenue justifies the infrastructure. If utilization takes years but financing assumes perfection immediately, the technology can succeed while the investment fails. Silicon can be artificial. Cash flow remains stubbornly real. There are 4 main ways the AI financing loop could come under pressure. The first is that revenue arrives too slowly. People can use AI constantly without paying enough to cover its full cost. Free products encourage adoption, but free users are famously unreliable debt. Service instruments. Enterprise customers may spend heavily, yet negotiate prices downward as models become interchangeable. AI can create enormous economic value for users while the infrastructure providers capture only part of that value. We have seen this pattern elsewhere. Consumers benefit, competition intensifies, prices fall, and the companies that funded the capacity discover that social usefulness and investor returns are not identical twins. The second risk is that compute prices fall faster than expected. This sounds positive. And for users, it is more efficient models. Custom chips from hyperscalers, stronger Chinese hardware, better software optimization, and competition among cloud providers can reduce the price of an AI task. But a data center financed on today's rental rates may struggle if tomorrow's computing becomes dramatically cheaper. The same technological progress that expands the market can weaken the economics of older projects. This is the strange feature of infrastructure booms. Success creates supply, supply lowers prices, and lower prices expose projects that required permanent scarcity. A GPU does not need to become useless to impair an investment. It only needs to earn less than the financing model assumed. The third risk is concentration. A remarkably small group of companies sits on several sides of the market. The same firms invest in AI laboratories, provide cloud services, purchase chips, rent computing, and distribute AI products. If NVIDIA also supports financing, the supplier becomes financially connected to customers whose spending supports NVIDIA's own growth. This can create stability during expansion because strong companies reinforce one another. It can create fragility during contraction because one company's problem quickly becomes another company's receivable. Guarantee utilization shortfall or canceled order. The system begins to resemble a group of climbers tied together by a safety rope. The rope prevents one person from falling alone. It can also ensure that nobody falls alone. The fourth risk is the price of money. Data centers are capital-intensive, and capital-intensive projects care deeply about interest rates. If inflation remains elevated, government borrowing stays large, or bond investors demand higher yields, financing costs rise. Higher costs reduce the number of projects that can meet return targets. Developers delay construction, customers scale back commitments, chip orders become less certain, technology valuations fall, reducing the equity cushion available to fund new capacity. Lenders demand stronger guarantees, which places more pressure on companies such as NVIDIA to provide support. The sequence can run in reverse: more financing creates more capacity creates more chip orders, and more orders create stronger valuations. But when funding tightens, fewer projects create fewer orders, and weaker growth reduces the ability to finance the next round. A guarantee is almost invisible when everything works. No cash leaves the guarantor, the project pays, and the promise collects dust in a footnote. If specific triggers are reached, contingent exposure becomes real. We do not know the proposed terms, so estimating NVIDIA's ultimate risk would be irresponsible. Investors should still distinguish between revenue from an independent customer and revenue linked to financing supported by the supplier. Both can be legitimate, but they deserve different risk analysis. The contracts matter more than the headline: who borrows, who owns the equipment, who absorbs overruns, what happens if OpenAI uses less capacity, and is NVIDIA's obligation capped, collateralized, or conditional? Those boxes remain largely empty. Now for the bull case, because shouting "bubble" whenever a large number appears is not analysis, it is cardio. NVIDIA may be making a rational decision. AI demand is real across coding, advertising, research, medicine, finance, and manufacturing. Infrastructure can also create demand. Abundant, cheaper computing makes previously uneconomic products possible, just as broadband-enabled businesses few predicted in advance. If insufficient compute is the constraint, faster construction can unlock revenue that does not yet exist. NVIDIA may also understand the risk better than outside lenders. A bank sees a private company requesting astonishing capital. NVIDIA sees utilization, customer pipelines, model architecture, inference demand, supply constraints, and the technical roadmap. Financing can also deepen NVIDIA's moat. If OpenAI builds around NVIDIA systems, software, networking, and future chips, switching becomes harder. NVIDIA is not merely selling a product, it may be helping design the financial architecture that keeps its platform indispensable. The headline may also exaggerate the economic risk. A guarantee ceiling is not a loss, and project finance can involve many lenders, collateral packages, long construction phases, and obligations never triggered. The chip figure is up to $350 billion and could span a large build-out. This is a multi-year project, not $600 billion hitting next quarter's accounts. Declaring triumph or disaster before seeing the contracts is finishing the movie from the trailer. How do we judge intelligent industrial finance versus circular excess? Use 5 numbers. First, AI-specific revenue, not total cloud revenue management enthusiasm, or the number of times agentic appears on an earnings call. Second, capital expenditure on chips, networks, buildings, and power. Third, free cash flow after that spending. Fourth, external financing. Debt, equity, leases, guarantees, and supplier support. Fifth, utilization. Are new facilities full? Are customers signing long contracts, and are rental prices holding? Or is capacity expanding faster than paying demand? The key relationship is AI revenue growth versus infrastructure growth. If revenue grows faster, the system becomes safer. If infrastructure outruns revenue for years, refinancing and optimistic assumptions become more important. Watch capital spending guidance, free cash flow, cloud margins, financing costs, and whether customers fund projects independently or require stronger guarantees. Also watch electricity, because every AI forecast eventually meets a transmission line, and transmission lines do not accept stock options. The evidence can move in either direction. The bullish case strengthens if AI revenue becomes more transparent. Utilization remains high. Customers sign long contracts without supplier support, and free cash flow recovers even as capacity expands. It strengthens further if OpenAI and other laboratories improve margins while paying market rates for compute. The bearish case strengthens if capital spending repeatedly rises faster than revenue, projects require larger guarantees, cloud prices fall, cancellations increase, or companies shift obligations into structures. Investors struggle to evaluate one quarter will not settle the argument. Infrastructure cycles unfold over years, but each earnings report should make the financing chain easier to understand, not harder. When management discusses another historic investment, listen for the answer to 4 basic questions. Who provides the capital? Who commits to use the capacity? Who absorbs the downside? And where does the final customer cash enter the system? The reported discussions do not prove that AI is a bubble, that OpenAI cannot purchase chips, or that NVIDIA will lose money. They may instead show that the boom is entering a new phase. Its first phase was funded largely by the cash flows of dominant technology companies. Its next may rely more on debt, guarantees, leases, project finance vehicles, and supplier support that can accelerate an industrial revolution while making the true source of demand harder to see. If AI revenue grows fast enough, NVIDIA's support may look like a masterstroke, using its balance sheet to remove computing's greatest bottleneck, finance a new economy, and secure future demand. If revenue arrives slowly, investors may discover that some demand depended on the financial capacity of the suppliers benefiting from it. The technology can be revolutionary while the financing remains dangerous. The internet changed the world, and many telecom investments still failed. Both were true. That returns us to the $600 billion boomerang. The number is not the conclusion. Contracts may change, exposure may be smaller, and neither proposal may proceed as reported. The signal is that AI now requires financial engineering on the scale of its technological ambition. It can write, code, reason, generate images, and explain your job with uncomfortable enthusiasm. Now comes the credit test. Can customers generate enough cash? Can projects earn adequate returns? Can long financing survive short technology cycles? And can growth continue when the supplier no longer supports every round? The machines may become smarter than expected. The debt will remain brutally human. It charges interest, demands repayment, and is unimpressed by benchmark scores. The biggest AI risk may not be technological failure. It may be that the technology succeeds, usage explodes, society changes, and some of the largest projects still do not make financial sense. Is NVIDIA intelligently financing the next industrial revolution, or is the AI boom beginning to finance itself? From this point forward, the most important AI model may not run inside the data center. It may be the financial model used to pay for it.